This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Apple impresses. The world's most valuable publicly traded company sells more iPhones than expected, proving demand isn't wavering for the flagship product.
So far, so good. Earnings are coming in slightly better than expected, but there's one thing that's starting to make market watchers a little nervous.
Ambitious acquisition. A Chinese company is breaking into the U.S. TV market with a multi-billion-dollar purchase, and some of the biggest names in Silicon Valley are taking notice. Those stories and more tonight on Nightly Business Report for Tuesday, July 26th.
Good evening, everyone, and welcome. By now, you probably know that we spend a lot of time talking about corporate earnings at this time of year. And today was one of the busiest days of all for profit reports, led after the bell by Apple. You also probably know that what the pros call earnings season is a game not of thrones, but of expectations. Beat the Wall Street forecasts, and investors love you, even if your sales and profits were lower, maybe even far lower than they were a year ago. Well, that is exactly what Apple did and exactly what happened in early aftermarket trading today. Apple, a stock you likely own in your mutual funds, even if you don't own it directly, blew past expectations. The company earned more than Wall Street reckoned. Its revenue was stronger than analysts thought it would be, and the company shipped more than 40 million iPhones in the most recent quarter. That's notable because analysts had been concerned that consumers just weren't upgrading their phones as often as they used to. Here are the numbers. The company earned $1.42 a share. That's 4 cents above expectations, a significant beat. Revenue came in at more than $42 billion, about $300 million above the estimates. Best of all, perhaps, management said sales for the fiscal fourth quarter look stronger than consensus. Presto, the stock took off, as you see there, in after-hours trading. Now, never mind that in this game of expectations and not of thrones, sales were down 14% from a year ago. And at $1.42 a share, profits were 43 cents lower than in 2015. And how about those iPhone sales? Even though they were stronger than expected, 7 million fewer were sold than this time last year.
Presto. Let's turn now to Dan Morgan for more on Apple's earnings beat and what the results suggest about the health of the company and the iPhone. He is Senior Portfolio Manager at Synovus Trust. Both he and his firm own shares of Apple. Welcome. It's nice to have you here, Dan.
Hi, Sue.
I know you're bullish on Apple. You have been bullish on Apple, but give me your thumbnail take on this report in particular.
Well, the fact that it was better than expected is at least encouraging. I mean, you're right, on all the different metrics, they look somewhat negative. But, you know, one thing I thought was really positive was gross margin came in at 38%. We didn't get a big drop-off in gross margin with some of the new lower-priced phones coming out. As you mentioned before, the guidance going into the fourth quarter was positive. And overall, you know, you talked about the game. It was better than expected. So the stock is up, even though it was negative growth.
A lot of people are pointing to the release, presumably later this year, of an iPhone 7. When they came out with the iPhone 6, it was a huge boost to profits because it was a transformational phone, bigger screen, more functions, so on and so forth. Can the 7 give them that kind of boost, or a smaller one?
Well, we're optimistic that iPhone 7 can. You look at the history, you just mentioned iPhone 6, iPhone 5 also. Huge boost in the stock price, huge boost in profits when those two releases came out. We're hoping that we can start to gain some momentum in fiscal year 2017. You remember they have their fourth quarter next quarter, then they'll go into their first quarter, hoping for about 74 million iPhone sales in that first quarter of 17. So start to kind of ramp up for this new iPhone 7, even though there's a lot of doubters out there, Tyler.
Yeah, and that's reflected to a certain extent, those doubters, in the stock performance down this year, 22%. Do you add to your position then, Dan, if you are optimistic and still bullish? What are you going to do with the stock?
We're still optimistic, Sue. We've owned the stock since 2005 at a cost basis of $5. So it's a huge winner for us. And so we look at opportunities when the stock pulls back to try to add shares in anticipation of the iPhone 7 and some of the other things that they're doing. So we still feel that the valuation is very low. It trades around 10, 11 times earnings, has a dividend yield over 2%. So you get kind of paid to wait for earnings to grow again.
All right. On that note, Dan, thanks for joining us tonight.
Thanks, Sue.
Dan Morgan with Synovus Trust.
Apple wasn't the only blue chip to report. Far from it. Six other Dow components released their quarterly results this morning. Caterpillar, Verizon, United Technologies, DuPont, and 3M all topped earnings expectations, while McDonald's did as well. Its shares, however, came under pressure because of a slump in same-store sales. That metric didn't measure up. And while the bottom line results may have looked okay, all of these global companies had a little something different to say about their outlooks. Start with McDonald's. It disappointed with global existing store sales growing only a little more than 3%. That was less than the 3.6% investors expected. So the boost from all-day breakfast may be losing a little steam. Still, McDonald's has now posted 4 straight quarters of positive sales. Caterpillar beat both earnings and revenue forecasts, but just like it did in April, CAT dimmed its outlook for the rest of the year and announced more job cuts. Continued strength of the U.S. dollar is denting CAT's global sales and hurting demand for its heavy equipment.
It's been a challenging period. What I'm most proud of is the way our people are responding, the way we're getting after cost structure and restructuring and getting through this in a way we never have in prior downturns.
3M also cut its sales outlook for the year, blaming difficulties in its electronic and energy businesses, especially in Asia and Latin America. Revenues missed for the quarter, though 3M did manage to beat earnings forecasts. DuPont is among the Dow components, raising its forecast for the year after surpassing expectations for both sales and profits. Profits rose almost 8.5% in the second quarter. Its CEO says a planned merger with Dow Chemical remains on track to close later this year. United Technologies, which beat both earnings and sales expectations, also raised its guidance. Politics figure into a climate of uncertainty these days, and CEO Greg Hayes thinks it would be a mistake to turn away from free trade agreements.
Everybody knows that free trade is what drives growth in this country. The loss of jobs in the manufacturing sector, primarily driven by productivity, not by offshoring. And I think as people understand the real causes of some of these reallocation of work to lower cost countries, they'll understand that we need to continue to support free trade.
Verizon's labor issues, that 7-week spring strike, ate into sales, down more than 5%. Verizon says it added 615,000 wireless customers in the quarter, but that's a 46% drop from last year. Verizon missed revenue estimates, but did manage to whip forecasts on profits. Here's how those companies performed today. CAT, UTX, they were the Dow's top performers. DuPont also higher, as you see there. 3M, Verizon, McDonald's did decline in today's session. Look at the fall for McDonald's.
Earnings season so far does not appear to be as bad as feared, but it's not great either. The decline in profits is just slightly better than what we saw in the first quarter, thanks in part to strong results from the banks. But now another part of the market is raising some concerns. Bob Pisani explains.
The recent decline in crude oil may be a serious problem for earnings in the second half. Oil, which has traded between $45 and $50 for the past 2 months, is now trading in the $42 range. That wasn't supposed to happen. Oil was supposed to stay in the comfort zone between $45 and $50 and then gently rise in the second half of the year. At the same time, oil company profits were supposed to bottom in the first quarter, improve in the second and third quarters, and then dramatically improve in the fourth quarter as firmer oil prices pulled everybody up. But oil isn't cooperating. Demand for gasoline is strong, but refiners have produced so much of it, there's a glut on the market. That's pressuring oil prices. Now, this morning, Morgan Stanley said oil could move into the mid-$30 range once again. Now, if that happens, earnings estimates for all the oil companies will have to come down because those earnings are based on higher oil prices. This morning, the CEO of BP said he expected oil prices to average between $50 and $60 a year going into 2017. Lower oil company profits is a big deal because it will likely take down estimates for the whole S&P 500. Traders are expecting those estimates to turn positive in the third quarter after 4 consecutive quarters of negative earnings growth. So to justify stocks at historic highs, the bulls need to argue that earnings are improving and declining oil is not helping. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And it did not help again today. Those declining oil prices produced a mixed day on Wall Street. Energy shares under pressure as investors comb through all of those earnings reports, and the Federal Reserve began a two-day policy meeting. The Dow Jones Industrial Average fell 19 points to 18,473. NASDAQ, however, light on energy companies, added 12. The S&P 500 gained a fraction. As for oil, domestic crude fell 0.5% to settle just below 43 a barrel.
To the economy now. Americans purchased new homes in June at the fastest pace in more than 8 years. The Commerce Department reports that new home sales rose 3.5% last month, and that's the best level since February of 2008. Low mortgage rates, a solid job market, and tight inventory have helped lift the real estate market. A separate report showed a more than 5% rise in home prices in May. According to the S&P Case-Shiller Index, that is down just slightly from the prior month.
A gauge of how Americans feel about the economy held steady in July. The Conference Board survey of consumer confidence virtually unchanged from June. The reading considered by many to be a sign that consumer spending could continue to support the economy in the second half of the year. Consumer spending makes up about 70% of all economic activity.
And while the latest economic data is positive, it's unlikely to sway central bank policymakers. An interest rate hike is unlikely when the Federal Reserve releases its policy statement tomorrow. And as Steve Leisman tells us, Wall Street expectations are changing dramatically.
Big changes in the CNBC Fed survey for July. Let's get right to it. In the prior survey in June, the street was looking for the next rate hike to come in September. That's now plus 3 months. The next rate hike now seen in December 2016. And now, when will the Fed allow that big $4 trillion balance sheet to decline? Had been expected May 2017. Now it's sometime afterwards. When will the Fed finally stop hiking interest rates? It had been thought the fourth quarter of 2018. Same now, but look at where they think the Fed's going to stop. Had been 2.6%. Now it's just 2.4%. So lower interest rates for longer for next year. The street just looking for a 1.2% Fed funds rate, up from the current 0.37. Now looking at the stock market, you can see the street seems to believe that most of the gains are already built in. A big comeback from where we were, that the concern about the economy and recession in January is giving way to better stocks. But looking for the outlook for 2016, most of the gains already thought to be built in. Only a 4% gain in stocks envisioned through 2017. But taking a look at interest rates, they continue to bring down the expected interest rate of the 10-year yield, currently trading around 1.6%, seen only rising to 1.8% next year and 2.25% in 2017. All of that comes with the same 2% or a little bit better growth that we've had over the past several years since the expansion began. The outlook for GDP next year, this year, just 2%, rising to 2.25% in 2017. That's the expectation among our 43 respondents, who include economists, fund managers, and analysts. For inflation, 1.6% this year, rising a bit to 2% in 2017. Some big changes in the expectations for the presidential election. For the last 2 months, the survey shown an 80% belief that Hillary Clinton would win the White House in November. That's now fallen to 52%. Donald Trump, he's up a bit. 15% had thought he could win the election in November. Now that's just up to 26%. But a big change you can see right there is the don't knows, up from 5% to 21%. For Nightly Business Report, I'm Steve Leisman.
And with Wall Street now less certain of a Hillary Clinton victory in November than it was, as Steve reported just a month ago, the Democratic Party prepares to formally nominate her for president, uniting behind the first female candidate to represent a major American political party at the top of the ticket. And tonight, Clinton's husband, former President Bill Clinton, will be on stage to make the case for Hillary. John Harwood is in Philadelphia for us tonight. John, in a party that's being pulled to the left by Bernie Sanders supporters, is Bill Clinton, a centrist, still the surefire rock star hit he once was?
Well, the party has moved to the left, but the center has moved to the left. The country has changed. It's a different makeup. The economy's different. We have more income inequality. So Bill Clinton is not going, however, Tyler, to focus his remarks, as we understand it, on the economic issues themselves, he's going to try to paint a very intimate portrait of Hillary Clinton as somebody who has committed her life and career to fighting for women, for kids, for social justice, trying to lift some of those unfavorable personal ratings that are weighing her down in this race right now.
Yeah, some enthusiastic delegates in the roll call vote behind you here, John. As that progresses, do you anticipate it will go smoothly?
I do, and all the signs are in that direction. Last night, Michelle Obama electrified this convention by saying, you know, I live in a house that was built by slaves, and now my daughters play with their dogs on the lawn, pointing to that history-making breakthrough they made 8 years ago. Hillary Clinton was nominated by John Lewis, the civil rights hero. Bernie Sanders was also nominated, and you had a lot of energy in the hall, but it was positive energy.
What was the reaction to the convention's first night last night? And I know Ms. Obama's speech was widely praised.
Her speech was widely praised, less so for Elizabeth Warren. Bernie Sanders did what he needed to do for Hillary Clinton. You can't trust polls in the middle of a convention, so we don't really know voter reaction. But if you look at the raw viewership totals, Hillary Clinton's convention on its first night got 26 million viewers. Donald Trump's last week, 23 million.
All right, John, thank you very much. John Harwood reporting tonight from Philadelphia.
And still ahead, rough quarter. Twitter did something for the first time since going public, and shareholders are not happy.
Twitter's string of disappointing quarterly results continues. The social media company reported its weakest revenue growth since its IPO back in 2013. It lowered its outlook as it struggles to grow its user base. When it comes to earnings, Twitter reported better than expected results after adjustments of 13 cents a share. Estimates were for 10 cents. Revenue of just more than $600 million, though, was shy of expectations, and investors were not impressed. The stock sold off sharply in initial after-hours trading, as you see there. Julia Boorstin has the one key takeaway from Twitter's quarterlies.
The key factor weighing on Twitter shares, the company's slowest revenue growth since Twitter went public in 2013, with more revenue headwinds ahead. Not only did Twitter's revenue fall $5 million short of projections, but the company's revenue outlook for the third quarter is far short of expectations. Twitter's COO Adam Bain telling me that while they're seeing advertisers shift over to Twitter's video ads, that marketers are not increasing their budgets just yet. Bain was bullish, though, that there are some good signs ahead for Twitter's advertising potential with its live streaming deal with the NFL coming up. Bain saying they've seen really strong demand for those ad packages, but not enough demand that the company could issue more bullish guidance. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
Profit falls nearly 60% at Under Armour, and that is where we begin tonight's market focus. The athletic clothing retailer said the impact of the closing of its rival Sports Authority dragged down its earnings. But even so, the results fell in line with estimates. Revenue was better than expected and was helped by strong demand for sports apparel and basketball shoes. Under Armour finished the day, though, down 5% to $41.36. Drug maker Eli Lilly saw both profit and revenue rise in the latest quarter. Sales were better than expected, while earnings fell in line with estimates. The company's CEO was happy with the results.
We're pleased with revenue this quarter. We grew 9%. I think it's important 8% of that was volume growth, and of that 8%, 6 percentage points came from new products we've launched since 2014. So this is exactly the trajectory we want to be on.
Eli Lilly shares rose 11 cents to $82.09. Mobileye, which makes self-driving car technology, is cutting its ties with Tesla. The company said it will continue to support existing product plans with the automaker, but will not enter into any new agreements. Mobileye said it plans to focus its efforts on creating technology for fully autonomous cars. Shares fell 8% to 45.33. Lower fuel costs helped lift profit and revenue at JetBlue. The airline beat earnings expectations, but sales were a little light. The company also said it may begin offering routes to Europe. JetBlue shares took off, up 8% to $18.67.
Anheuser-Busch has sweetened its takeover bid for British rival SAB Miller, the maker of Bud and Stella Artois beers, raised its more than $100 billion offer after the drop in the British pound caused SAB Miller shareholders to raise concerns over valuation. Shares of Anheuser-Busch up a fraction at $126.60. Freeport-McMoRan saw its loss narrow in the latest quarter, but the mining company still missed earnings estimates by a penny. Revenue also wasn't good enough to top street targets. In addition, the company said it plans to sell up to $1.5 billion worth of shares in an effort to trim debt. Shares up 2% on the day to $12.68. And Panera saw its profit fall as costs associated with refranchising some of its restaurants weighed on results. But the bakery chain still managed to top estimates. Shares initially rose following the after-hours news, offsetting a 4% drop during the regular session, where it closed at $207.61. Profit and revenue up at Centene as the health insurer added new members and benefited from a recent acquisition. The results were ahead of analyst estimates. The company also said it set aside $300 million to cover potential losses in its individual commercial businesses in Arizona, and that sent shares down 8% to $68.87.
Still ahead, why a Chinese company you've likely never heard of is making a big move into America's tech hub of Silicon Valley.
Here's a look at what to watch tomorrow. Boeing reports earnings, continuing the parade of quarterlies from Dow Components. The Federal Reserve will issue its decision on interest rates. Central Bank expected to leave rates right where they are, but the statement will be scrutinized for clues that a hike may be coming soon. Pending home sales will give us another read on the housing market, and that is what to watch for a Wednesday.
Fiat Chrysler is revising the way it counts its monthly sales figures. Because of that change, the automaker now says its 75 consecutive months of sales gains actually ended almost 3 years ago. The decision to change the calculation comes amid reports that it was overstating its monthly tally. Fiat Chrysler recently confirmed that it's under investigation by the SEC and received inquiries from the Justice Department over the way it accounts for vehicle sales.
A Chinese tech conglomerate is making a two-front push into the U.S. and specifically into Silicon Valley. Li Echo is spending billions to buy a U.S. company, and it also recently made a big real estate purchase that has a number of well-known tech firms taking notice. Aditi Roy has our story.
Silicon Valley has a new player in town. Chinese-based Li Echo, known as the Netflix of China, announced plans today to purchase U.S. electronics maker Vizio for $2 billion. Under the deal, Li Echo will take over Vizio's hardware and software business, while Vizio's data business will spin out as a private company. Li Echo is a tech powerhouse in China and the top TV content provider in the country. Vizio is the top seller of HD TVs in the U.S. With Vizio in its fold, Li Echo is better positioned to execute its global strategy and expand its presence in the U.S. The company also has plans to launch a new line of smartphones and TVs in the U.S. and even has a self-driving car designed to compete with Tesla's Model X. CEO YT Jia, who is considered the Steve Jobs of China for his big push on innovation, spoke exclusively to CNBC about the acquisition and his company's plans for the future.
After the acquisition of LeEco and Vizio, we will insert a great influence in the global TV industry. We hope that through the synergy between the two companies, we can lead the TV industry and the internet industry into a new age. Call it the ecosystem era.
The news comes just weeks after the $14 billion tech company expanded its footprint here in Silicon Valley, snagging prime real estate from Yahoo. The company is now scouting for local talent, with plans to nearly double its workforce by the end of the year.
We hope that in the future, not so far away, we can bring entire ecosystem model to the U.S. and bring a brand new value and service for the American users, including our phones, LE TVs, even our cars and our cloud services.
In April, Jia told CNBC Apple's phones are outdated for the Chinese market. Now with a foothold in Silicon Valley, Jia wants to go head-to-head with Apple and Google in their own backyard. For Nightly Business Report, I'm Aditi Roy.
And finally tonight, the scientific community may be seeing the rewards of the Ice Bucket Challenge. 2 summers ago, you might recall, people dumped ice water on their heads, posted the videos online, and challenged others to do the same as a way to raise money for ALS. In total, $115 million were donated, and some of that money went towards a global initiative to study that disease. And now, as a result of that research, a new gene has been identified that contributes to ALS. The discovery could help identify a potential therapy. That is my favorite story of the day.
That is good news.
It's good news.
That is really good news.
Want to do the Ice Bucket Challenge? We should just keep doing it. Keep raising more money. That does it for us tonight on Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you right back here tomorrow night.